If you've been investing in stocks, indexes, or ETFs long enough, you may have seen a market that just feels like there's trouble brewing ahead. Maybe these securities are long-term holdings you don't want to sell. Maybe they're trades taking a temporary setback. If you think your stock could experience a temporary downturn but don't want to sell it, you could consider the protective put strategy, also known as the married put. You'll pay a premium to buy the put option, but you can look at it as buying insurance for your stock index or ETF. If the price drops, the put provides protection, but doesn't limit the upside potential of your stock index or ETF. The protective put is a relatively easy strategy and involves buying one put option for every 100 shares of stock that you own. Buying a put gives you the right to sell your stock index or ETF at a set price called the strike price, up to and including the day of the expiration of the option. You need to decide the sale price of your shares and the time period for the sale. You can create a protective put ranging from a week with weekly options to several years with long-term leaps. Here's an example using an out-of-the-money put to protect your 100 shares of XYZ stock. A put is out of the money when the strike price is lower than the current underlying security price, with shares currently trading at $63. You buy the 60 strike put for $2, and let's say it expires in 30 days. This gives you the right to sell your stock at $60 per share for 30 days, no matter how low the price drops prior to expiration. The stock and option will both move around in price, but the put is subject to daily time erosion. Options lose value or decay every day. It's something to be aware of. Let's look at what happens at expiration when the stock is above or below the strike price of $60. If 30 days later the stock is higher than the put strike, then your loss is easy to calculate. The put expires worthless, so you've lost the $2 you paid, which equates to $200 for every put option. The option expires without value, and you can move on to the next trade. Just figure in this $2 loss to whatever the stock did during this time frame, and you'll have the net P&L for your account. For example, if XYZ jumps to $70 from $63, then the stock profits $7 less the $2 option premium for a net gain of $5 or $500. Regardless of whether the position profits or not, when the stock moves higher, rather than looking at this as a loss, consider it buying peace of mind and the cost of purchasing insurance. Suppose at expiration, 30 days later, the stock price is $55. You've lost $8 in the stock, but the put option is now worth $5, which gives you a $3 option profit. Don't forget you paid $2 for the put, your net damage. Taking into account the stock loss and option profit is $5 rather than $8. The good news is that $5 turns out to be the most your position can lose. For instance, let's look at what happens if the stock drops far below the strike price, let's say to $25 per share. That gut-wrenching move represents a $38 loss on 100 shares, but the 60 strike put is now in the money and is worth $35. This ends up netting out your $38 stock loss with a $35 value of the put, and you have a loss of only $3. The $3 loss and the $2 that you paid for the put option gives you a total maximum loss of $5, which is $500 per 100 shares. Good thing you bought that put option after all. At expiration, puts will be exercised if they are 1 penny in the money, and your shares would be sold at $60. To avoid having your puts automatically exercised at expiration, you'd simply sell your option prior to expiration, letting the proceeds of the put sale hit your account rather than part ways with your stock. If paying for put options is too much for you, then you could consider turning the position into a collar strategy to achieve the same protection, but without incurring as much cost. To learn more about the protective put and other strategies, Visit the OIC website at optionseducation.org.